Here's something the IRS will never tell you but has absolutely no problem with you knowing. The tax code is full of legal hiding places for your money. Not loopholes, not gray areas, not strategies that require a team of lawyers and a willingness to risk an audit. Explicitly designed, fully legal, government sanctioned mechanisms that allow you to take money that would otherwise be taxed and make it disappear into vehicles where it compounds invisibly, sometimes for decades, before the government ever sees another dollar of it. And here's what makes this genuinely interesting. The people using these mechanisms most aggressively aren't the ultra wealthy with offshore accounts and complex trust structures. They're high income earners with regular jobs, regular employers, and access to the exact same financial accounts that most people have, and most people are dramatically underusing. The difference isn't access, it's awareness. And the gap between what most people do with their income and what the smartest earners do with theirs is worth, conservatively, hundreds of thousands of dollars over a career. My name is Dave, and I love helping people understand that the tax code isn't just a system that takes money from you. It's also a system that tells you exactly where to hide it first. And most people never read that part. Let's start with the foundational concept that makes all of this work. The government taxes income. But it doesn't tax all income equally. And it doesn't tax it all at the same time. Depending on where your money goes between when you earn it and when you spend it, you can legally defer taxation for decades, reduce the total amount taxed permanently, or in some cases, eliminate taxation on your gains entirely. These aren't theoretical strategies. They're the specific mechanisms the tax code was written to encourage. The government wants people saving for retirement, managing healthcare costs, and investing in small businesses. So it built incentives into the code that reward those behaviors with tax treatment that looks from the right angle almost exactly like hiding money. The smartest earners understand this. They don't think about their gross income as the number that matters. They think about how much of that gross income they can legally route away from the IRS before it becomes taxable. And the gap between what they earn and what they allow to be taxed in the current year is where their wealth actually gets built. Here's the first hiding place, and it's the one most people use the least aggressively: the 401k or 403b at work. In 2025, you can contribute up to $23,500 to a traditional employer retirement account. Every dollar you contribute reduces your taxable income by exactly that amount in the year you contribute it. So, someone earning $95,000 who maxes their 401k at $23,500 is only paying income tax on $71,500, not $95,000. At a marginal tax rate of 22%, that's $5,170 in taxes they didn't pay this year. Money that stayed in their account, working for them, compounding tax deferred, rather than going to the IRS. And here's the compounding picture that makes this genuinely powerful. That $5,170 the IRS didn't get this year doesn't just sit there. It earns returns. At 8% annually over 25 years, $5,170 becomes $35,400. The tax deferral didn't just save $5,170 in taxes this year. It produced $35,400 in additional wealth over the life of the investment. Now multiply that across every year of maxing the account. The cumulative tax savings compounding over a full career doesn't produce a marginal improvement to the retirement balance. It produces a fundamentally different retirement outcome than someone earning identical income who never understood what the account was actually doing. Most people contribute whatever gets them the employer match and stop. The smartest earners treat the $23,500 limit as a floor, not a ceiling they're reaching for. And if they're 50 or older, the catch-up contribution limit is $31,000. The government is explicitly offering to let you hide even more. The second hiding place is one most people have heard of and almost nobody uses correctly: the Roth IRA. Here's the specific thing that makes the Roth different from every other tax-advantaged account. It hides money from future taxes rather than current ones. You contribute after-tax dollars. The government has already taken their cut on the way in. And everything that money becomes after that, every dollar of growth, every decade of compounding, every investment gain across potentially 40 years of accumulation, the IRS never touches again. At $7,000 annually starting at age 30, invested at 8% returns, the Roth IRA produces approximately $1.86 million by age 65. The IRS's share of that $1.86 million on withdrawal. Zero, not reduced, not deferred. Zero. The hiding mechanism here is temporal. You're not hiding from current taxes. You're hiding from the taxes that would otherwise apply to a $1.86 million account when you eventually access it. Without the Roth, that money in a taxable account would generate capital gains taxes on every dollar of growth. Inside the Roth, the gains are permanently invisible to the tax system. The income limits are worth knowing because they catch people off guard. In 2025, the ability to contribute directly to a Roth begins phasing out at $150,000 for single filers and $236,000 for married filing jointly. Above those thresholds, direct contributions aren't permitted. But here's what the smartest earners know that most people don't. There's a legal mechanism called the backdoor Roth conversion that allows high earners above the income limit to effectively access Roth benefits anyway. You contribute to a traditional non-deductible IRA and then immediately convert it to a Roth. The conversion is taxable only on any gains between contribution and conversion, which on an immediate conversion is essentially zero. The money then lives in the Roth permanently with all the same tax-free growth treatment. This isn't a loophole, it's a strategy so well established that the IRS has explicitly confirmed it's legal. High earners using it are doing exactly what the tax code permits. High earners not using it are paying taxes on gains they didn't have to pay. The third hiding place is the one with the most unusual structure and by far the most powerful tax treatment of anything available to ordinary earners, the Health Savings Account, the HSA. Here's what makes the HSA genuinely different from everything else. Every other tax-advantaged account has one tax benefit. The 401k gives you a deduction now. The Roth gives you tax-free growth later. The HSA gives you both simultaneously plus a third benefit that neither of them offers. Contributions are tax-deductible. The money grows tax-free inside the account. And withdrawals for qualified medical expenses are completely tax-free even in retirement. 3 separate tax benefits in a single account, the only vehicle in the American tax system structured this way. In 2025, the contribution limit is $4,300 for individual coverage and $8,550 for family coverage. And here's the specific strategy that transforms the HSA from a healthcare account into one of the most powerful wealth-building vehicles available. Pay all your current medical expenses out of pocket. Keep every receipt. Let the HSA money stay invested in the market untouched. There is no time limit on when you can reimburse yourself for qualified medical expenses, which means you can pay a doctor visit today and reimburse yourself from the HSA 20 years from now, tax-free after the original contribution has been compounding at market returns for 2 decades. Someone who contributes the family maximum of $8,550 annually for 25 years and achieves 8% returns without withdrawing a dollar has approximately $673,000 in completely tax-free money available for medical expenses. Given that the average couple retiring today faces over $300,000 in healthcare costs throughout retirement, that $673,000 essentially makes one of retirement's largest expenses disappear. The requirement is a high-deductible health plan. Not everyone's situation makes that appropriate. But for people it does fit, the HSA is hiding money from the tax system in a way that no other account quite replicates. The fourth hiding place is one that exists outside employment entirely, and it's the one that produces the largest individual hiding capacity for people who qualify. The SEPIRA, or Solo 401k, for self-employed income. Here's why this matters even for people with regular jobs. A significant and growing number of people have some form of self-employment income alongside their regular employment. Freelance work, consulting, a side business, any income reported on a 1099 rather than a W-2. That self-employment income is fully taxable as ordinary income plus self-employment tax, which adds another 15.3% on top of regular income tax. The combination can push the effective tax rate on side income to 35%, 40%, sometimes higher depending on the state and the total income picture. The SEPIRA allows self-employed individuals to contribute up to 25% of net self-employment income, with a maximum of $70,000 in 2025. The solo 401k has similar limits with additional flexibility for Roth contributions. Someone earning $50,000 in self-employment income who contributes 25% to a SEPIRA is hiding $12,500 of that income from the IRS in the current year. At a combined tax rate of 35%, that's $4,375 in taxes not paid this year. Compounded at 8% over 20 years, that single year's hiding produces $20,350 in additional wealth versus paying the tax and investing the remainder in a taxable account. Multiply that across every year of self-employment income, and the difference between someone who understood this tool and someone who didn't on identical income is enormous. The fifth hiding place is different from the others because it doesn't involve a retirement account at all. It's the tax treatment of long-term capital gains. And understanding it changes how you think about the relationship between investment holding periods and actual wealth building. When you sell an investment you've held for more than 1 year, the gain is taxed at the long-term capital gains rate rather than your ordinary income rate. For most middle-income earners, that rate is 15%. For very high earners, it's 20%. For people in the lower income brackets, it's 0. Compare that to ordinary income tax rates of 22%, 24%, 32% at various income levels. The hiding mechanism is time. Hold the investment for 1 year and 1 day rather than less than a year, and the tax rate on your gain drops significantly. Not through any complex strategy, just through patience. A $50,000 gain on an investment held for 13 months versus 11 months is the difference between paying 15% and paying 32% on that gain. That's $8,500 in taxes on the same profit from the same investment, with the only variable being 2 months of holding time. The smartest earners structure their taxable investment accounts with this specifically in mind. They don't chase short-term trading gains because they understand that the tax treatment of those gains eats a significant portion of the profit. They buy, hold, and let time convert ordinary income tax rates into capital gains rates automatically. It's not exciting. It's not a sophisticated strategy. It's the kind of thing that feels too simple to be worth as much as it actually is, which is exactly why most people don't fully internalize it, and why the ones who do quietly keep significantly more of their investment returns than the ones who don't. Here's the thing about all 5 of these mechanisms. None of them are secret. None of them require expensive professional advice to access. None of them are available only to people with special connections or unusual circumstances. They're all sitting in the tax code, explicitly permitted, fully documented, available to anyone who earns an income and decides to use them. The 401k is on the HR benefits page. The Roth IRA is available at any brokerage in about 15 minutes. The HSA is offered alongside the high-deductible health plan. The SEPIRA is available to anyone with $1 of self-employment income. The capital gains holding period is a number of months. What's rare isn't access to these tools. What's rare is using all of them simultaneously at their maximum capacity. Most people use 1 or 2 partially. The smartest earners use all 5 aggressively and treat every dollar that escapes taxation in the current year as a dollar that gets to compound in full rather than in part. The difference between those 2 approaches, calculated across a full career, isn't a marginal improvement to the retirement balance. It's the difference between retiring with what the market gave you and retiring with what the market gave you, plus everything the IRS would have taken if you hadn't known exactly where to put it first. That's what hiding money from the IRS looks like when the IRS wrote the hiding places into the code themselves. Use them.